The six biggest banks in the U.S. are seen by the credit markets as being too big to fail. Three of them each hold more than 10% of the nation's total bank deposits. The six big banks exist because the government helped them merge. These banks get to borrow money more cheaply than their competitors because they're so large. The credit markets assume the government won't let them fail. These banks are too big. The solution is to break them up into more manageable and competitive companies. That's what happened to Standard Oil about 100 years ago, and history shows that's a good model for today. Senators Brown and Kaufman have proposed the Safe Banking Act, which would break up the big banks by placing a statutory cap on their liabilities. That way risk would be more evenly distributed. The result would be a more stable, rational market. The Federal Reserve has had the power to limit the size of banks for 40 years. It's time for Congress to step in and force the issue. While they're at it, this would be a good time to reenact Glass-Steagall, the law that used to keep commercial banks, investment banks, and insurance companies from operating as one company. In 1995, the biggest six U.S. banks' combined assets were well under 20% of gross domestic product. Today, they are above 60%. Whenever too much economic power is concentrated in too few hands, instability and social chaos are inevitable.
Nuclear Podcasting. Creative Commons Attribution Non-Commercial No Derivatives.